Hey guys, happy Monday. Logan here with Live Free Investments. Joining me today is Parker Webb with Third Space Property Group. How's it going, Parker?
Hey, good, Logan. How are you?
Doing really well. We're setting up here for a big month. We've got a 37-unit apartment complex that we are closing, and we're excited to start really working on our next opportunity for our retail investors. And so today's brief webinar is to simply introduce Parker with Third Space Property Group, as well as introducing our new offering that we're going to be bringing to you, our investors. So our goal is threefold today, to answer three different questions. One, why should you care about this offering? Two, what's in it for you? And three, why us? And so we're going to start actually why you should care. Not only do I think that you should care about real estate investing from a macroeconomic standpoint, and there's a lot of different things that are going on in the landscape of stock markets and other investments. I think you should care about real estate investing because it can really help you generate passive income. And not only that, we always talk about the ideal investment, and the ideal investment is income, depreciation, equity buildup, appreciation, and leverage. And this one hits a lot of different variables on here. So Parker, without further ado, I'm going to let you take it over and tell us a little bit about why we should care about this offering. And after we answer that question, we'll dive into the next one.
Sounds great. Well, perfect. I think first of all, why should we care about this offering? I think what you mentioned there, Logan, about things getting a little bit funny in the public markets, and people are wondering what's happening in the public markets. And I think now is one of the best times you can get into real estate, and especially get into certain sub-asset classes like self-storage. Self-storage, mobile home parks, multifamily, these were the most recession-resistant assets the last time around. And so that's always what's kind of stood out to us about the asset class, is really finding great opportunities with great returns that also have lower beta. We want to make sure that in a down market, we're covered there as well. And so this property that we have here is a recently converted climate-controlled self-storage facility. It's 84,000 square feet. We are purchasing it from the developer, where we have a lot of opportunity to come in here and get this thing leased up and really deliver an incredible return. And, of course, there are a lot of tax favorable advantages investing in real estate generally, and there are a couple extras on this one that we'll get into. So.
Excellent, Parker. I appreciate that. We actually traveled up here to Lansing, Michigan a few weeks back, and I can tell you guys this was by far the largest roof that I have ever stood on. It's an incredible facility to see what they have done, and it's really exciting because it does basically have some opportunity zone benefits to this property, but there's a caveat to that, and I really like the niche that Third Space has really carved out, to find properties that are ready for TCO, and they still qualify as opportunity zone projects. So, what do you think is the best next step, Parker? Should we talk about why Lansing first?
Sure. I think we can talk about why Lansing. So Lansing, Michigan is the state capital of Michigan. It's a town that was an old auto town 30, 40 years ago. A lot of the automakers left a lot of the Rust Belt cities, and so a lot of markets have been slowly struggling to come back. Lansing has done a really good job in the last few years, especially the last 5 years, of starting to be a growth market. And so a lot of the reasons for that is because it is the state capital. You have large state employment. Michigan State University is here with over 40,000 students and all of the employees and professors who have to support all of that. And you have large hospital systems that are here in place as well that are large employers in the area. And so all those come together to make a very strong base of employment, which has allowed for really an entrepreneurial type of environment to start to spread in the city of Lansing, take advantage of all the research over at the university. And so we see the city of Lansing as being a spot with great stable income. Its median household incomes are growing faster than the United States as a whole. Its populations are growing faster than the state of Michigan as a whole. And so we see Lansing as really kind of ripe for improvement, ripe for development, ripe for growth, and we want to be a part of that.
Absolutely. When we were up there, Parker, I have to say that it was really exciting to drive right around the riverfront there and see quite a few new developments or recently completed developments, and it really seems like there is some some investment going, especially into the downtown area. And then obviously with all that growth there, people need a place to store their stuff, and they also need affordable places to live, which we both know Lansing has a lot of affordability and, has a large migrant population, which, leads to a lot of rentals being there for people that, are living there maybe 6-7 months out of the year.
Right, absolutely. Yeah, and so one of the things that we always look at when we're going into these spots is looking at some of those population growth and where that population growth is coming from, and you hit it on the head. It's coming from a population that is a big user of storage, and we're going to have some of the best products in the marketplace to offer. Yeah.
Well, I think that people really need to take note of all of the Class A multifamily that has been being built and will be delivered in the next 2 years. CoStar just put out their report, and over 666,000 new Class A multifamily units will be delivered. Now, some of those are being required to have some affordability component to them, but a very, very small sliver of that. And so from a multifamily standpoint, if you're not buying B class, if you're not buying C class that can be pushed up to B class, I'd be very weary of putting a lot of what I'll call faith in this Class A multifamily property. So I'm glad to hear that self-storage historically has been a really resilient asset class. And I'm excited to dive into that a little bit more as well.
Absolutely. I was pulling up some demographics, which we'll get into here in a second.
Okay.
So, Logan, if now's the right time, should we jump into the deal and talk through this property a little bit?
Absolutely. Thanks, Parker.
Perfect. So 930 West Holmes is the address of this property. And again, this was a converted building. And so that's one of the things that we like to see is really repurposing existing assets in a communities that are ripe for being repurposed. And so while we're buying an existing building, this building has a brand new roof. All the interiors are brand new. All the units are brand new mechanical, electrical, and plumbing. Basically, we bought the original shell, improved the shell even, gave it a nice facelift. All new site work, so we've got new asphalt, we've got new trees and landscaping and site lighting and new signage. So we were able to get into an existing asset, but have quite a bit of improvements into it, and now it's going to operate like a brand new building. So this development as a whole, which we're buying right at certificate of occupancy from the developer, we're all in on this about 9.6, for which we're raising 3.1. We have a $6.5 million loan from a bank here in Kansas City called First Missouri Bank. And First Missouri Bank has given us some great terms, and we'll get into some of those terms as we go through all of this. So sponsor co-investment, we're putting in 10% of the 3.1 that is going into this property. We like to have some skin in the game, and 10% is the number that makes some sense. And one of the things that we like to see more than anything is unlevered return on cost. And so this means that on our purchase price, based on the NOI we'll have when this is stabilized, it's a 9.76% cap rate in a market where the storage is trading for 6 to 6.5 caps. And so we have big spread where when we take this thing to a future exit, we'll have a big profit margin built in on the get-go. So
awesome.
So a little bit more about this. The city of Lansing did support this project with a TIF of $825,000, which will be reimbursed over 16 years. We're going to bring in Extra Space, which we'll get into a little bit here. They are the largest third-party manager and the second largest REIT in the self-storage space. So one of the things we like to do is we like to find great deals and bring great deals to the table, and we like to put great operators in place to manage those deals. And so Extra Space is one of the best in the game, and we want them involved in this asset. And another piece here that we'll dive into a little bit more is that as part of this, there is a 1.5-acre pad site, which we currently have in our model to sell at a pretty conservative price, but there will be additional opportunities to either build to suit or ground lease, depending on what the market's telling us.
Excellent. I think, too, Parker, we learned a little bit about the, everybody wants to know, okay, well, what about new developments that could turn into self-storage facilities? So why don't you touch on some of the, I don't know if that would be legislature that has been passed, that's some local codes, but let's talk through, what the with the cannabis laws that they want to make sure that they're not having any more facilities like that come into the city, which has to do with self-storage, actually.
Yep, absolutely. So one of the things we always like to look for in deals that we're getting into are barriers to entry. That gives us a competitive advantage in the marketplace. Obviously, if you go into large municipalities, New York, LA, barriers to entry are obviously price, zoning, the politics, et cetera. Well, one of the things that we saw as a great barrier to entry for additional projects, which means it's going to keep the supply down, is that because of the cannabis, medical cannabis throughout the state of Michigan, cannabis dispensaries have been, opening up all over the place. And the city of Lansing has wanted to slow the number of dispensaries that open up in the city of Lansing. And so their zoning code is the exact same requirement for medical cannabis dispensaries as well as self-storage. And so basically at this point in time, the city of Lansing has put an unofficial moratorium on rezoning any properties to the zoning. That way, no additional dispensaries can be built outside of areas that are already pre-zoned. So that's obviously a huge barrier of entry for more projects in Lansing, but for us, that's great. That means supply is going to be kept down. We don't have to worry about a bunch of new projects coming into the marketplace and pushing our rents lower. And so that's one of the things that we like to see, and that's a great barrier of entry in this marketplace.
Absolutely. Love that word, moratorium, right? That's a kind of a negative connotation, but I think that's a very big point to make sure that people understand, because I believe that there was one, maybe even two projects that have been tried to be redeveloped into self-storage since the inception of this project, and it's actually been turned down. So that's a really important note to kind of highlight there.
Absolutely. Well, perfect. Well, let's talk a little bit about Extra Space. So we mentioned before, Extra Space is the best-in-class operator in the self-storage space. In same-store performance, they outperform all the other operators in terms of revenue. They're about tied in terms of the expenses. And then on NOI, of course, when you have better revenues and low expenses, you're going to have the best NOI in the market. And so, certainly people say, well, could you operate this yourselves or maybe choose a cheaper mom-and-pop operator? Frankly, Extra Space is great. They charge a 6% property management fee, which is pretty standard in the marketplace, and they deliver the best-in-class product. For us, what makes the most sense is to bring in the group that is best capable of executing our business plan. That way we achieve the goals that we're set out to achieve.
Yeah, absolutely. And I think that it's also important for an exit strategy, but not only that is a lease-up period, right? You just never can tell what a mom and pop is going to do from a lease-up standpoint, how motivated they might be. Extra Space has numbers, they have statistics. Dylan at Extra Space has been wonderful to talk through on phone calls, and we can model that against over 450 other facilities that have gone through this lease-up phase as well. So I think that's something to be said about having the best-in-class operator for sure.
Absolutely. And, one thing that we like to see is Extra Space operates the facility in this market that's actually closest to us. And so we have great data sets that allow us to know how the market's been doing. That facility had they expanded that they completed in August of last year. And since that time, they have leased up 40% of the units in the total facility in that year that they've been in place. There's about 3.3% per month, which is ahead of even the market average as a whole across the United States. So Extra has done a great job of leasing up that facility, and we think they're going to do a great job leasing up our facility as well.
Great. Wonderful.
So here's a couple photos as we talked about. The site work is all being completed right now. At the end of this month, we will have all brand new asphalt, all brand new site lighting, all brand new landscaping. And so all of that will be complete, and we'll have new photos to share with everyone. These photos are from about 60 days ago before we started on all that site work. You got some interior photos. You can see the office in the bottom left there, which is sort of the office kind of retail space where our guests will check in, our tenants will check in. You see the space there that you have a kind of hallway with some of our storage. And then kind of give you a regional map as you had said, right where the Lansing logo is there, or the words there, that's perfectly in downtown. It's about 3 miles away from where we are, so we're very close to downtown Lansing. We're on 2 major arteries, so the 2 roads, Martin Luther King and Holmes, they each produce 20 and 30,000 vehicles per day, so great vehicles per day coming by us, and it's in a largely residential area. So if you can see kind of around where the 930 West Holmes logo there is, it's large, dense residential population, which is exactly what we want to see for self-storage.
Absolutely.
So site aerial here, you can kind of see how the property outlines. You've got retail all around us, which is great. Retail drives traffic. In the northeast corner there of the site, you actually have a new axe throwing bar. They just started their renovations of that building. And then down here on sort of the south side of the property is where you have this 1.5 acre pad site. That's where we will intend to either sell that ground, build a suit, or ground lease.
Absolutely. Yeah. And, I think that what's important to note out here, there might be some opportunity to pick up a couple of these retail sites and either knock them down for more visibility or make them something that would be even complementary and in the future. So I think that's one right on the, well, if I'm looking at the building on the south side, I believe. Is
correct. Yep, that's southeast corner.
Yep. Okay.
Yep. Perfect. And so this gives us a little information about what we're seeing in that pad site. We have pretty conservatively underwritten that we would be able to sell it for $7.50 a foot net. Comps in this market are $15 for comparable pad sites, and so we think we're being pretty conservative net of fees and closing costs and everything else. We think we'll be able to beat that $7.50, but that's what we've baked in today. Additionally, we have the ability to go out and build medical office or quick service restaurants or potentially a retail strip there that would generate even more kind of revenue, even more return to our investors.
Excellent.
So if we dive into the numbers a bit real quick, the total cost just at 9.6. Again, that return on cost, it's that unlevered return, 9.76%. It's basically our stabilized NOI divided by our all-in cost. You've got a market cap rate of 6.5, which gives us a spread of, slight typo there, 326 basis points is our spread on the development cost. So what that means is we anticipate during our hold period here, which in this model is 5 years, this is an average stabilized cash on cash of 14.26%. We're going to be generating IRRs over 20%, equity multiples over 3 times, and very solid stabilized debt service coverage ratio. As we talked about, we have First Missouri Bank on the debt side here. Extra Space, who's going to manage this asset, also offered their bridge loan program. Our relationships with First Missouri Bank in Kansas City, we were able to negotiate even more favorable financing. But just to kind of show how much Extra Space is interested in this asset, they want to manage it, they wanted to do the loan, and they want to buy it when we're done. So we anticipate rental income of 1.3 and some other income. This is retail sales, late fees, et cetera, just under $70,000 a year, which brings our total revenue to 1.37. We're budgeting for stabilized expenses of about $435,000. That gives us an NOI of $937,000. And so everyone knows kind of how we got to these numbers. These are all come from Extra Space and working with Extra Space, working in the market, spending a whole lot of time underwriting the market and getting through to kind of really identify projections that we feel comfortable with. Here's the sources and uses, which I won't go over too much, but I will jump down to the preferred return and promote section. We're going to be paying a 9% preferred return. Then we'll 30% to the general partners, us, over that 9% up to a 20% return, and then 40% over 20 up to 25, 50% over 25. On the fee side of things, we're charging an acquisition fee of 2%, an asset management fee of 1% of the invested equity on an annual basis, which will be paid quarterly. And on the disposition fee, we'll charge a 3% of the sale on the back end when we look to sell. In the event that we hire an outside broker or agent to handle the transaction, our fee would be offset by the amount that we pay them. So if we paid an outside broker a 3% fee, we would take no fee on the back end.
Got it. And go back one slide for me, Parker.
Mm-hmm.
So here we go. Let's talk about the net rental income and how long we believe that the lease-up will take and what our break-even point is, because that seems to be a question that a few investors have asked us so far.
Absolutely. So we are budgeting for a 48-month lease-up. Most self-storage facilities lease up in 36 months. As we talked about before, the facility nearest us has leased up at a rate that would be about a 27-month lease-up. So we're being very conservative in saying that we're leasing up over 48 months. We anticipate hitting this in that amount of time. In the event that we are leasing up at that 3.3%, obviously we would hit kind of that fully stabilized in 28. We're saying 48 months, and then we're budgeting an exit in month 60. Based on our 48-month lease-up, we hit that break-even point at about 18 months into ownership, which you'll be able to see on the sources and uses. We have $1 million baked into this for operating reserves and interest reserves to carry us to the point that we're actually break even.
Excellent. Thanks for running us through that.
Of course. And so you'll see here in the sources and uses, the $700,000 of interest reserves and $250,000 of operating reserves. So demographics of the area, you've got incomes right just under $50,000 average. One of the things that we like to see about that is, I've done a lot of work in the retail space with retailers that like to see those levels of income. And one of the things that we like about it from a self-storage standpoint is incomes in this range actually use a disproportionate amount of self-storage compared to maybe higher income ranges. And so we like these demographics. You've got good, dense populations, reasonable income with enough disposable income to spend on storage. So we feel good about that. And then finally here in the OM, we've got our disclaimer, of course, acknowledging that the projections that we're making are projections. They're based on data sets that we pull from public and private sources, but that we cannot guarantee future-looking statements.
Yes. And so what are we seeking on this investment, Parker?
So we are So we are raising obviously 3.1, of which 10% is our contribution. So we have about $2.8 million that we're raising. We're looking for $100,000 minimums. In the event that investors are willing to invest $500,000 or more, we will actually negotiate to give some of the general partnership to those investors. So large investors will actually get returns even better than the returns that we have stated above.
Yes, and we are raising from accredited investors, guys. So that's simply an IRS classification. Last time I checked, it was for the last 2 years, $200K or above if you were single, $300K or above if you are married, or a net worth of $1 million, and excluding your personal residences. So we need to make sure that everybody understands that this is open to accredited investors, which allows us to be in regulations of the SEC to be able to generally solicit for investors. So last thing that I want to leave off on, we did not get to why us. We will do that in a later question and answer webinar, or just talk to Parker or myself and we can tell you why us. But one last thing I want to mention that we didn't really touch on this is the capital gains piece of this and the opportunity zone that this happens to be in, Parker. So let's leave off on that.
Right, exactly. So this building is in an opportunity zone, which we see as an enhancement to the asset. Obviously, we look at deals based on their merit, and if it's in an opportunity zone and our investors can take advantage of that, we structure it that way. So our investors who do have capital gains or are eligible for opportunity zone investment would be able to receive the opportunity zone benefits, which include a 15% reduction in their basis when they pay their taxes in 2026, a full step up in basis when they go and sell, and obviously a deferral of all those taxes until 2026. For those who do not have capital gains that are eligible and want to invest ordinary income, that is still an option. We're going to bifurcate this raise where those who have OZ will be in one pool, those who do not will be in another. The terms will be the same. We will complete a cost segregation study within the first year of ownership, and we'll be able to pass through additional bonus appreciation year one. So we're taking advantage of all the tax favorable advantages that this asset has.
Yeah, and guys, look, it's month 10 of this year, so if you have had a large gain, capital gains, probably not from real estate, but from a stock or selling a piece of art or something else that you can roll into this property and this project and utilize these OZ benefits, it's going to be very, very important that you understand what those ramifications are. Happy to talk to you guys more about that, and even talk to a couple of our CPAs who are some leading, what we'll call experts in that area. Parker, thank you so much for running us through this project. We're super excited, and until next time, guys, live free.
Thanks, Logan. Live free.